Horlicks Network 18, Mission Poshan, Bhavishya Roshan.
Hi, let's discuss some numbers now for Escorts, which has been a really strong stock. The growth continued for tractor sales in the month of May. Bharat Madan, the CFO of the company, joins on the phone line to talk about that. Mr. Madan, good morning. It's been a 20% plus growth that you've seen in tractor sales this time around. I just wanted an outlook for the full year because last time we spoke with you, you indicated that the industry might do 9 to 11%. But what about Escorts itself? What are you targeting given that the first few months have looked good?
I think our guidance for first quarter was in any case higher. So we had indicated the industry growth to be somewhere between 15 to 18% for Q1. The overall for the full year we said it will be somewhere around 9 to 11%. So we are still maintain the overall guidance for the year for the industry. And obviously we have been maintaining that our growth will be beating the industry numbers in terms of growth pattern. So I think that's what we are seeing in the first 2 months, and probably this quarter also we'll see the similar number. And probably June should be another good month for the industry.
Okay, so June should be another good month for the industry. When you say you'll beat the industry guidance, will you do as good as the 26% that you did last year, or it's hard to sort of beat that performance?
Well, I think today the base is pretty high. I think in the industry numbers, so I think obviously that sort of growth is really slightly difficult to achieve. But you never know. I think let's see how the things really pan out.
Okay. Can you tell us a little more about what the trend is looking like? I mean, how much has demand picked up? What kind of HP tractors are doing well? And, what do you expect going ahead as it is election year as well?
I think overall demand looks good. I think on the ground, barring certain states, especially in certain pockets like Rajasthan or Karnataka, Maharashtra, and sort of MP. I think there are 3-4 states which are slightly under stress as of now, where we not seen the growth coming through. So hopefully, I think with the kind of rainfall indication that we're getting from IMD, probably that should help, especially the central market in MP, which is one of the stronger pockets, and there's also some part of Rajasthan. Overall, I think we've seen good growth happening in the basic categories of 30 to 50 HP segment, which is the 85% of the industry. The growth continues to be there. There was some more growth is seen now coming in the lower HP side, which is sub 40 HP category. And for Escorts, the growth is coming more from that category.
Okay. So in the sub 40 HP category, if you are seeing growth, would that dilute your margins in any way, or do you think you can maintain the margins above this 12% level?
Well, I think our guidance for this year is still 100 basis point improvement in the margin. So I think we maintain that guidance here now. In spite of the fact, yes, that will impact slightly our realizations adversely, because being in the lower HP will be obviously slightly lower realization and slightly lower margin. But in spite of that, I think whatever initiative company is taking on the cost front, that should make up for the shortfall. So we still expect overall margin to be better this year.
Okay. Bharat, if you can give us more clear, volume indications or expectations for the current year. As Sonia was saying, it's not just elections. A lot of the FMCG companies, consumer durable companies, have been speaking very positively about rural demand. Do you see that continuing? Some volume guidance on, various ranges of tractors?
Well, like I said, overall guidance for industry is still maybe it will be close to double digits, so only 9 to 11% is what we guided. So obviously the numbers will vary from quarter to quarter. Like I said, first quarter will be very strong, and Q2 may not see that sort of same growth. Because Q2 we had seen last time a lot of festive sales getting preponed and all of GST sales deferral which happened in last year from Q1 to Q2. So that impact will be there in Q2. But Q3 again we are expecting with the good monsoon, I think Q3 will be a very strong quarter this time. So overall I think, let's see, I think if the Q3 can really give you positive surprises, so it can have to change the entire outlook of the industry for the whole year.
Okay, just one final question. Yeah, one final question before we let you go, Mr. Madan. On the railway business, the last time also you were very optimistic about that, and even in the quarter gone by, the margins have improved quite a bit there. Any new orders in the railway business and any, improvement that we can expect?
So order book is strong there, so we continue to have 350 crores plus order book there in the railway business, which is, I think, good enough to take this entire current year's sales numbers. And margin-wise also this year we're looking at margin expansion across all 3 verticals, whether it's railways, construction or tractors. So I think overall company should look at expansion margin now this time.
Okay. Well, we'll leave it at that, Bharat. Thank you very much indeed for joining us with your thoughts. So that's double-digit volume growth expected. we'll do one thing. We'll take a break, but we're not going to take a break because we will have to look at how the markets are doing. At the moment, we are seeing a continued weakness as far as the Nifty is concerned, but the Nifty Bank has been able to manage to hold in the green. It's the advanced declines that's very painful. It's 3.3 stocks in the red for 1 in the green. So, you know, almost 75% or 80% of the market is in the red at this point in time compared to yesterday's already, bad levels. Yesterday we had an across-the-board fall across all indices. So market's still looking in a spot of deep pain, especially with the mid-cap space. Ashwini Gujral is with us now. Ashwini, what are the contours now on the Nifty? You said that you would go short on the Nifty and long on the Nifty Bank. What are the contours on the Nifty now?
See, today is a pullback day.
Okay.
Early morning, first half an hour, the bears tried to break yesterday's low on Bank Nifty. They have been unsuccessful, which means the market needs to go higher for them to try again.
Okay.
So chances are Bank Nifty is looking at a 100-150 point pullback. Similarly, 30 to 50 point pullback on the Nifty. Because if you are in this sort of depression, then the volume just evaporates. And today you may see some follow through of global strength if it comes in, because today the market is positioned in a manner that if the Nifty moves up another 10-15 points, you will see a flood of short covering. Because after a 1,000-point decline on Bank Nifty, you cannot fall another 500 points.
Okay.
So the pullback will also surprise people.
Okay. No. So yeah, you did say that you're going long on the Bank Nifty. You're also getting long on the Nifty then?
Yes, obviously if Bank Nifty goes up, Nifty will also go up. And given that, there's been a lot of carnage, a lot of negative sentiment. So I think that needs to clean out a bit before fresh selling starts. But this is a sell on rally market. Just that yesterday you had a bit of excesses on the downside. So maybe you get a 30-40 point, rally on the Nifty. But first couple of hours, you'll see short covering.
Okay, what about individual stocks then, Ashwini? Just for the rest of the day, what would you be looking at?
Again, I divide the day into, a couple of hours at a time. So Tata Global is a buy with a stop of 258, target of 274. RIL is a buy with a stop of 940, target of 965. And Petronet is a buy with a stop of 214, target of 232.
Okay.
Okay, well, let's get Rajat Bose as well into the conversation. Rajat, any stocks that you would be looking to trade now? I mean, both on the long side or on the short side?
I would be selling two stocks in the futures segment. Indigo June futures, I would put a stop above 1160.50 and target would be 1135 and 1125. The stock looks pretty weak. The other stock is even weaker, that is Stride Sassoon. Stride Sassoon, my stop loss in June futures would be 368.20 and 351 and 343 are the two levels that I'm looking at. If needed, carry the positions because the new high, new low statistics suggest that weakness is likely to continue in the market and these two are generally weak counters.
Just a final question to you, Ashwini. Nifty IT, is there a trade now?
Nifty IT does not have those sort of shorts. Okay. So you need shorts in this market because buying is very low to take the market higher. So Nifty IT may at best remain stable, but I think upside you can only bet on things where there are short positions.
Okay, gentlemen, thanks a lot for joining us and giving us your thoughts. From one set of strong sales, that's from Escorts to Eicher Motors. Eicher Motors posted a nearly 30% rise in commercial vehicles in the month of May. Vinod Agarwal, the MD and CEO of Volvo Eicher Commercial Vehicles, joins us now to talk about that. Mr. Agarwal, good morning and thanks for joining us. I wanted to start by asking you about the trend for the full year because, in FY18, the total commercial vehicle volume growth was about 12.5%. What do you think the company can do in FY19? Will it be as good or even a better performance this year?
No, commercial vehicle industry, after various types of disruptions due to one reason or the other, it is now back to normal and it's on the recovery path, and I would say strong recovery path. And based on that, I think it's a good prospects for us as well. And last year we had, as you mentioned, we had the highest number of sales of 66,000, close to 66,000 trucks and buses, with 12.5% growth in the volume terms, and on the top line in value terms around 18-19% growth. We were more than 10,000 crores in the top line in last full year. So first 2 months also have been good, with around 30-31% growth. And here on we are looking at very good growth in the CV industry, and based on that we are looking at good growth for us as well.
Okay. Well, there could be some disturbances because of the rise in fuel prices as well as the rise in interest rates. Are you already seeing a rise in freight rates? Will that be a problem at all, or do you think you will get good demand in spite of it?
No, definitely whenever there is increase in the diesel or there is increase in the interest rates, there are some short-term problems, but then at the same time, if the economy is growing, these have to be passed on, and everything becomes normal within a short period. Okay. If the economy is growing, like we are seeing huge buoyancy in the market, sure, especially in the e-commerce companies, or in the you can say the LNG, CNG transportation, or various types of cement growth, or rural economy, and so based on that the sentiments are very positive.
Okay, so
that's the main thing.
What would you estimate? I mean, after all, your May growth has been extraordinary. For the year as a whole, what can we work with? 25%, 20%?
It's difficult to say, because last year first quarter was not so good. First quarter was very low base because of BS3 to BS4 migration. So I would not get swayed by the growth in this quarter. Okay. But on the whole, the sentiments are positive. So on the whole, I'm looking at good growth. But let's not go by that. If we have growth of 31%, we will sustain this type of growth for the full year.
I wanted to ask you a little bit more about the overloading ban. I mean, so far, because of that ban, things have looked pretty good. The demand has picked up. But now, because it's election year, the expectations are that that ban could get eased in certain states. If that happens, do you think it could impact volumes in any way?
No, if you look at this overloading restriction from where these are coming from, these are now largely coming at the toll plazas. At toll plazas, which are privately owned roads, there are 10 times the tolls. In case there are overloaded trucks, you have to pay 10 times the toll. Now, 10 times the toll is huge, is a huge amount for any transporter for a trip. So the overloading restriction is coming from these penalties. So I think these are going to stay. Now, within the state movement, if the transporters avoid these toll roads, then of course they can continue to have some overloadings. But I don't see that is possible, because you see a lot of other benefits of using these roads, because there are a lot more efficiency, there are a lot more other savings, like you can get better fuel efficiencies, you get better productivity. So I think this is going to stay, and these overloading restrictions are leading to lot more demand in the CV industry, because replacements are more, and then at the same time you need better trucks, you need better productive trucks, so that you can have better efficiencies, better productivity. There is a lot more focus from the customers, like for example these e-commerce companies or pharma companies. They are insisting on deliveries as per their standards, as per their they are talking of delivery in hours rather than in days. Earlier it used to be days. Yeah. So all the things are changing. So I see these are very, very positive developments.
Okay, well, just a final question then. Since you're very optimistic about demand, have discounts come down in the industry? Will you all be able to report better margins in FY19?
No, if you look at our margin trends, if you look at last year margins, last year in spite of all the discounts in the market, our EBITDA margins were for the full year around 9.5%, okay, and for last quarter it was 10% plus. So in spite of the discounts in the market, there are other ways to improve the margins, like through cost management or better price management, or you don't have to run after the discounts. There are discounts in the market, but that's a market competitive situation. Okay. And in spite of these discounts, one has to manage the costs and manage the price in a better manner. Oh, so right. I think those are going to stay, and we are not worried about that.
Okay, Mr. Agarwal, thank you very much for joining us with all those details about prospects for Eicher Motor commercial vehicles. Well, market's still a bit static, a 0.25% cut on the Nifty. Let's get you some macro perspective, especially about global trade. Here's a chat that CNBC had with former Reserve Bank Governor Raghuram Rajan at the sidelines of the Nomura conference in Singapore. Former Governor Rajan is stressing on the need to bring down the US trade deficit. He says that he is looking at 3 Fed rate hikes this year.
At this point, the biggest risk is the combination of rising interest rates and some untoward action on trade. I think it's the perception that with all the leverage that's out there, interest rates rising are already an issue that we'll have to deal with, but that's out there. The great uncertainty is what happens with trade. If we have a trade conflagration in the next few months, that could really hamper the global economy. I do think there is benefit in India having a good relationship with China and vice versa, because these are 2 big countries that can do a lot of activity, of economic activity together. I do think that one of the reasons the countries are trying to form better relationships with each other is because of the unpredictability of the US administration at this point. So there is a catalyst out there which is pushing these countries to talk more together, but I think the fact of their talking is a good thing both for the countries and for the world. It's not coming at the expense necessarily of relationships with other countries. The latest news suggests the US economy is actually strengthening, is doing better, is actually doing quite well for an economy in its 92nd year of job creation. So my sense is the Federal Reserve is on a raising path, which it's not going to step off until it feels it's much closer to neutral. And I think most people would say neutral is between 2.75% and 3% at the short end. That means we're probably looking at 3 rate hikes this year, unless something really untoward happens in Europe or in some of the big emerging markets to create global turmoil. But it has to be really bad, in my view, for the Fed to step off this rate rising path. Certainly June appears baked in, but probably 1 to 2 more this year, after which the Fed may start looking around.
Okay, so that's the former governor saying 3 rate hikes inevitable from the Fed. And yesterday we had the current governor writing in the Financial Times, telling or arguing with the Fed that they should step off the pedal because, but of course he was arguing more in terms of step off the pedal in terms of quantitative easing. He was arguing that the Fed should not crunch its balance sheet very quickly because the US government is in borrowing mode.
Okay, well, let's get back to our own markets, because we have, we of course can worry about the macros endlessly, but let's drill it down to the micros. Mitesh Thakkar is with us. Mitesh, this market once again belongs to the bears, at least for the time being. The Nifty is now down about 25 odd points. What are you going to do on individual stocks now?
Yeah, so I think, very clearly, as I said, barring IT, we are trading with mostly short bias, and I would continue to explore more of shorting opportunities, though right now I have 1 buy and 1 sell call. Tata Chemicals is breaking down, so sell with a stop at 738, look for targets of 704. While Bajaj Auto, which had a big breakout on the day its numbers were announced, I think now has completed a pullback, is at good support areas, so buy with a stop at 2840, look for targets of 2970.
Okay. Well, Mitesh, we'll leave it at that. Thank you very much for joining us with your 10 a.m. trades. There is deep pain in the market. You can't ignore the fact that there are 4 stocks in the red for 1 in the green. So that's 80% of the market, lower than where it was yesterday. And remember, yesterday was a fairly red day, especially for mid-caps and the banking stocks, but generally for the market. So this is, 3 days of pain on the trot for the markets. And look at the advanced declines. That's telling you the story. But how is the world looking at us? My colleague Nimesh Shah is at the Morgan Stanley Investor Summit, and he has with him a very, very special guest who can put India into perspective among emerging markets. Nimesh, over to you.
Thanks, Lata. Yeah, you're right. I'm having with me Jonathan Garner, the Asia strategist for Morgan Stanley, and he's been bang on his call on emerging markets, including India, since the beginning of the year. So I'll ask him about all this, and of course about the India as well. So Jonathan, thank you very much for talking to CNBC TV18, your 20th annual India Summit. You've been very bang on since the beginning of the year on the emerging markets, including India. First, on emerging markets, do you think this is parallel to what you saw in 2000? And there is still more pain?
Yes, there are some similarities. Firstly, thanks for interviewing me. It's great to be here in India. Yeah, I think the similarities are manifold. We think we're nearing the end of a global economic upswing that in this case has gone on for 9 years, and we also had one almost throughout the 1990s. So if you look at the way that we come to the end of the cycle, we've got tightening of monetary policy in the US and China, the two largest economies, tightening policy at the same time. We've got the oil price starting to really act as a headwind to growth, and we've got quite high equity valuations as well. So that's very similar to the 1990s, particularly in big cap tech.
I was looking at a note, and it very clearly says that the upside is capped for EMs, including India as well. Today you wrote a note that now maybe you're seeing a bit of a pullback into the emerging markets. Tell us what do you think right now EMs are, and how much upside you can see from here?
Well, the EM index peaked at 1270 in the last week of January, so shortly after we wrote our year ahead piece. It's fallen almost 12% in dollar terms since then, so it's had a pretty meaningful correction. So that leaves it about 3 or 4% upside to our current target. So tactically, it looks a little bit more interesting, particularly as the dollar is not so well bid here. But strategically, those issues that I mentioned previously, they're still with us, and that means we do have to be very careful in positioning in the market.
I'll ask you about global macros and crude and everything. But first on India, you've reduced your overweight on India by good 150 bips since the beginning of the year. We've already seen a bit of correction, not in the index level, because at the index level, India is just down 4% in dollar terms, Y2D. But there is a big correction in the mid cap and small cap. Your reading on the markets and overall pressure on the mid cap and small cap.
Yeah, so if you look at India, it is still an overweight for us. So it's not as challenged by some of this macro environment as some of the underweights that we've had this year. But you have got that higher oil price in a country which does still run a large current account deficit. I mean, it's not as big as it was, but it's large compared to, say, many other countries in Asia that actually run surpluses. And so we put it in a group that maybe includes Indonesia, that's had to hike interest rates at the end of May. We've obviously got an RBI meeting ongoing now. So it's nothing like the 2013 taper tantrum when India's macro position was worse. For example, inflation was much higher in 2013. But there is that kind of, let's say, tendency that pushes rates up, whilst the cyclical recovery is still quite young here. And again, that maybe comes back to the SME point that you make. For SMEs to do well, you need a really fully fledged cyclical recovery rather than the nascent cyclical recovery we have. But when you put it all together across the whole index, and we do like some of the mega caps here in India, it still ends up as an overweight, but not a large one.
Okay. What is the Morgan Stanley house view right now on crude? And then I'll ask you about your view on rupee as well, because that will impact a lot of IT stock where you're bullish on.
Yes, that's right. So if you actually look at the crude oil price, we were arguing late last year that it could average $75 on Brent this year. And now recently we've moved up our forecast into the 90s for late 2019. And it's testament, again, to these late cycle forces. We have been in a global synchronized upswing, and that's obviously helping the demand side. But also our analysis on the supply side indicates that the shale supply response is not as big as in the previous cycle, and OPEC supply discipline is likely to be with us. So that is a traditional challenge for India on the current account side. But there are some stocks that one can play that benefit from higher oil prices in this market. So one name that we've owned in our list all year is Reliance Industries, which is very positively geared to that. And then on the rupee side of things, which you mentioned, again, it's one of a group of EM currencies that has traded towards the weak side this year. It's not as weak as some of the other currencies that are more challenged from a macro perspective, for example, the Turkish lira or the Brazilian real, which has done less to close those imbalances since 2013. But we do also want to be thinking here about some of the export earners that exist in the Indian market. And we broadly would prefer the IT services names to the pharma names. The IT services names are much more late cycle in terms of how they interact with the corporates in the advanced economies, which are likely to increase their capex spending and their IT services budget.
Within IT, Jonathan, if I remember correctly, you have TCS in your focus list as well. Beyond TCS, are you bullish on the mid-cap IT as well? Because that's where you've seen massive rally in the last 2 quarters.
TCS is a name that certainly has been highlighted by our analyst team. We don't in our group tend to look so much at the mid and small cap names in India because our institutional clients tend to be more focused on the larger cap names.
Sure. You spoke briefly about being underweight on pharma, and we've seen most of the pharma stocks in India corrected and pretty much at a 52-week low. Are you getting a sense now that this is a time to now at least bet on few large pharma names, or are you still being underweight?
Well, the healthcare sector globally is a very interesting play on demographics, but the Indian firms have had this very strong niche in generics, and some of what we've seen is really regulatory in relation to the FDA issues that some of the firms have faced. And our judgment is right now that we probably would still keep that sector somewhat on a cautious bias.
Okay, coming to the global markets now, at least the global growth seems to be synchronized. How much more rate hikes do you expect from Fed this year? And what could be the potential impact on EM currencies and EM economies?
Well, the Fed is largely, not completely, but it's largely endogenous to the global economy in terms of how it evolves. So I'm not that bothered as to whether it's 2 or 3 hikes. The important thing is that they're continuing to hike and that private financial indicators such as the LIBOR rates have also been moving up, and corporate credit spreads have been widening. So the corporate cost of capital in the advanced economies is rising quite rapidly. And again, that's typical late cycle. China is also tightening and somewhat more difficult to predict on a monetary policy basis than the US. But it's that combination of both tightening at the same time that really ensures that we're in this late cycle environment.
So what are the key risks that you'll be watching out for from a global point of view, which can impact a lot of emerging markets like India? Whether it will be crude or whether it will be currencies?
Well, we've talked about a few things in this interview already, but one we haven't talked about is trade protectionism, which is clearly worsening. And from India's perspective, it's not a very large manufacturing-oriented economy. It does, in fact, some of the, for example, the visas and some sort of licensing and regulatory issues that may affect corporate India, so that's something to watch out for. But certainly for broad Asia, when you look at, say, technology, hardware or autos, two industries that are very integrated in relation to supply chains, they have a lot to lose from tariff hikes that seem to be coming through now, then that is an additional source of risk to the long-run global macro outlook. And there's very significant sector and stock effects in Asia at the moment that are playing out.
Are you penciling in concerns of trade wars as well when you say that the upside is capped for emerging markets? Is that also priced in that there could be potentially some trade wars as well between US and China?
Well, we mentioned this as a risk as long ago as our November year-ahead piece, and as we've gone through each of these, let's say, increases in tension, we have further ratcheted up our concern on that, and we mention it again in today's note. Again, it comes back to the fact that we can have a small tactical bounce here, but we're a long way from being strategically bullish, so it is definitely overall a negative from a market outlook perspective.
Coming back to India, while you said that you're still overweight on India, the one reason why a lot of strategists were overweight is because they expected earnings to come back and earnings to revive. We've not seen that in Q4 as well. I've seen some reports where even for 19 and 20, they expect some bit of downgrades to the earnings. What is your general sense on earnings in India, and are they really troughed out?
So Aridham Desai and our colleagues here are slightly lower than consensus on earnings growth, but they do see 2 good back-to-back years coming, and it's been a long time in coming, this cyclical upswing, and it's been impacted by both global factors, but also the domestic tightening of policy post-2013, and then the implementation of GST and demonetization. But there's plenty of indicators around, for example, cap goods imports, the pickup in lower-level discretionary spending that suggests that it is going to come through now. So that is an important reason for actually maintaining a modest overweight in India. If we don't have an earnings upswing for any reason, then the valuations could leave the market somewhat exposed.
Okay. Jonathan, I was looking at a sectoral positioning, and you're overweight on the industrials and the capital goods space. Yes. But it's largely been pushed by the government spending. We still haven't seen the private capex picking up. Yes. What is your prognosis? Is that your overweight on Indian capital goods is largely that the government spending will go up, or do you think now the private capex is going to pick up?
I do think private capex picks up, and indeed capex more generally in the emerging world. And again, remember a name like Larsen & Toubro, for example, has exposure to the Gulf region, which was quite a problem for the firm when oil prices were low, but should be somewhat better in this environment.
So what would be an avoid for you right now? Which is the sector which you think is not something where valuation supports, and there are macro headwinds as well, which you'll avoid at this point?
Touched a little bit on pharma already, but actually if you look at sectors like consumer staples and telcos, they're still fundamentally challenged in many of the countries that we follow, including in India. So it's to do with competition, it's to do with disruption from technology firms and the reduced power of brands in the traditional consumer staples. And that's something we're seeing on a worldwide basis, including in US and Europe.
Jonathan, the one big argument for India to underperform in 2018-19 is the heavy political calendar year for India. We're going to see some state elections and the general election next year. Yes. How much that is a worry for global investors when you talk to your clients?
I don't think they're that focused on the elections next year, but I do think you're right to mention them. And I think, again, what we need to be looking for is whether some of the fiscal discipline that we've seen under this government is maintained in the run-up to the elections or not. It would be quite dangerous to relax fiscal discipline in this current late-cycle global macro environment. So I think that's the main lens by which investors would look at the situation.
Jonathan, when you talk to your clients, both in India as well as in the global markets, what is the general perception towards India? Have they started, losing some faith and they're like looking to cut down their overweight positions? Or still a lot of the larger investors are bullish on India? What's the general sense?
So investors are still overweight India, but they're at quite a low ebb in terms of that degree of overweight. They were significantly more overweight in, say, 2015 than they are today. But it is still a market that people are excited about in terms of the long-run growth prospects. It's still a market that has higher ROE than the average in emerging markets and a better than average long-run track record of earnings growth if you go back, say, 10 or 15 years. So, yeah, clients are not in a sort of euphoric state about India, but they are still overweight.
Okay. Jonathan, you track the flows very closely, and the China A-share are going to get included into the MSCI later this year. That will probably cut down the India weight to some extent is what I believe. Will that lead to a bit of pressure in terms of FII outflows, or you think that is pretty much priced in at this point in time?
It's not a huge deal for India because India is not going to lose as much weight as other markets that have a higher weighting in the EM index, say like Korea or Taiwan. But we are recommending an off-index sort of exposure prior to the inclusion of A-shares. We were doing that before they were included, and we would be overweight China A-shares as part of an overweight we have on China. But I don't think it's of huge significance for India.
The other thing is, Jonathan, there were some recent announcements by MSCI that they may look to cap the India weightage, given the problem that the Indian exchanges are having with SGX. Is that a reality? Do you think that can be possible, that the India weightage is capped simply because there is this big, big fight going on between the Indian exchanges and SGX?
Yes, again, I'm not the expert on that, but it's certainly something that I'm aware of, and we've been following quite closely what MSCI have been saying about that. More generally, across the Asia region, what we're actually seeing is exchanges doing greater tie-ups between each other. For example, the Singapore Exchange and Bursa Malaysia in Malaysia. So that's certainly something that is, if it does go through, is somewhat counter to the trend of increased exchange tie-ups in the Asia region.
But will that have an impact in terms of flows into India, or the India perception can change for global investors if that has to happen, that MSCI caps the weightage on India?
I don't think it's as important as things we've already touched on this interview, like the overall economic growth outlook, the fiscal position, the impact of the oil price. But it's certainly something that's worth mentioning. So you're not the first person who's asked me about that.
Sure. Jonathan, what can change your view on being cautious on emerging markets? I mean, what are the few things, if that go right, you might change your view on emerging markets, and you might see a bit of an upside from you?
I think a weaker dollar is important, and the dollar has stopped rising in the last, let's say, few trading sessions. I think it's important that monetary policy tightening, let's say, becomes more obviously towards the end of the tightening phase without damaging growth, rather than just carrying on tightening in the US and China. I think it's important that the oil price doesn't go up too much further, because that's always, it was likely to crimp growth towards the end of the cycle. And then again, it's just naturally sort of earnings growth hopefully coming through, and that brings the forward multiple down. And one of the reasons we were so worried late last year was that the forward PE for EM had reached the 95th percentile of its long-run range. So it is already adjusting lower. So that is why we're sort of healing a bit. But overall, we think it's too soon to go strategically bullish yet.